Good morning. Welcome to Morning Call. I'm Latha, Venkatesh, and with me is Anuj Singhal. We are missing Sonia Shenoy today. Should be joining us later in the day, though. Well, at least the global markets are greeting us with a whole lot of green. I think Nikkei is up about 2-3% for the third straight day. Yeah. Wall Street has been up 2% for the second straight day. And clearly the market is now being able to put behind the monster fall that it saw most of this week and late last week as well. To be fair, there has been some very good data coming out of the United States. The second quarter GDP is coming in at 3.7. The first estimate was 2.3. So that's very good data. And increasingly, the weekly jobless claims are also coming in lower. And this time it came lowest in 5 weeks. Then you have the July pending home sales data, which rose about 0.5%. So basically, the US economy is seen as being in ship shape. Now, there are still doubts being expressed with the Chinese devaluation and some severe falls in commodity prices, whether the US will be able to export as much in the third quarter or in the second half as it did in the first half. But for the moment, the markets are actually celebrating the fact that a lot of developed market data is coming in as usual, and that has led to such a sharp short covering rally. We speak about equities, but the commodity rally is the one that's taking your breath away. What the equities did over 3 days, the Nikkei and the Dow, the oil market has done in a day or maybe in an hour.
Yeah. Morning, Latha. So
does this look like, again, a dead cat bounce, Anuj?
Well, dead cat bounces are very sharp and powerful. So even if that is the case, the fact is that it will reflect on the screen. I mean, yesterday, if someone would have been short or would have taken fresh shorts, it would have been taken to cleaners. Yeah. And that's going to continue today as well. The SGX Nifty is indicating that the start would be not even at 8,000, but maybe even above 8,100. The SGX Nifty is 8,137. That's the futures data. You take out the premium, somewhere around 80 or 8,100 is where the start is for the SGX Nifty, for the Nifty, Latha. The problem for this market is that there's been just way too much selling, and highs are being used to sell by FIs. Yesterday, there was 3,500 crore of selling. I mean, we expected FI selling.
No, actually, that's what I wanted to ask you, primarily before I come to the technicals of today's trade. Will we be able to participate in the global recovery as much? Because I know FII data is being countered by very good DII buying in India, but these sell numbers are not ordinary numbers. Now for the month, this becomes even worse than what it was in August of 2013. Yes. Okay, in proportion terms, it's less because at that time, the Sensex itself was a smaller number, so the market cap was a little less. But do you think we will be able to recover as much as global markets?
Yeah, I mean, we will be prisoner to what's happening in global markets. And the sense I get is that the market has a bit of a clean run towards 8,200, and if that's taken out, towards 8,400. 8,400 remains the threshold for any counter trend rally. Make no mistake, yesterday was a counter trend rally. What you're going to see today is again a counter trend rally. Till the time you see stability in global markets, then this market remains in a counter trend rally. The big question is that, was this just an aberration fortnight for the global markets, for the global equity markets, a bit of a scare, and then the market moves on? If that is the case, with the benefit of hindsight, you again had a bit of a bottom at around 7,800, 7,900, and the market is ready to move on. If, however, things are going to get uglier from here on, and if 2008 is a template that you want to use, in that case, all these rallies would be sold into, and all these rallies would actually be opportunities to lighten your positions. In any case, the sense I get is that these are not the rallies in which you should be building fresh portfolios. These are the rallies in which you should be churning your portfolios, should be getting out of garbage, should be getting out of junk stocks, and maybe getting into quality stocks, or maybe getting into cash to buy at later stage. Because the sense you get is that this market at some point in September will again have a revisit towards 8,000, because it does look like that the mother market is still not settled. You've seen 2 big days in US market, but a lot of this is again short covering, a lot of this is market bouncing back from oversold levels. But something has changed in global equity markets. Nimesh has sent us some fund flow data as well. Yes. There's been quite a bit of outflow from equity markets. There's been quite a bit of inflows into debt and into safe havens, some other safe havens. You've seen quite a bit of move in yen, for example. So the sense I get is, and I could be wrong, is that this is a counter trend rally, which at some point would be sold into. But this is not a market in which you want to sell immediately, or short immediately, because the short covering bounce can be really powerful. The market fell from 8,600.
Absolutely.
So, 8,200, 8,300 is powerful course for short covering bounces. But Latha, for me, the big question is, which way the global cues will shape up. And that really, is something that I want to ask you.
Yeah, there are two things that appear to have changed in the global markets. Or maybe one big thing, really, China. Everyone is now coming to terms with the fact that the Chinese PMI data was merely the last straw in the camel's back. That there was some complacency building even in developed market equities, and that needed a correction anyway. When along with that you got 2 or 3 accidents in China, one, their seeming fumbling or bungling over how to handle their equity markets and this wild swings in, suspending 50% of the shares from trading. Those kinds of arbitrary measures kind of flummoxed the market. The next step was the devaluation, which actually was completely misread. And I was shocked by the way in which the market was reacting, because it was all of 2 and 3%, a total of 5%. 5% depreciation of euro and yen happen all the time, and markets don't react so wildly. And China had been told by the IMF that it must allow market determination of its currency. The biggest fault lay with the fact that they did not communicate. If it was said in very clear terms that in abiding by the IMF requirements and given our future intent to one day be the basket of currencies for an SDR or global calculations, we are slowly getting market determined, and hence this depreciation, perhaps the market would have reacted very differently.
Okay.
But the PMI data, which came on the back of that and came a little lower, kind of sealed the fate. So clearly, from hindsight, and that's always a very bad way to read markets, from hindsight, that the Chinese set of events were more an excuse.
Yeah.
Already there was too much of complacency in US markets, and now that also got unraveled. But the ground terrain has definitely changed with respect to China. Now almost every analyst, even those who study China very intently, tell you that 6.5 with difficulty is what China will produce, and maybe they will plod on to that level. Now that if China was contributing 50% of the world's incremental GDP, then that 50% reduces considerably. They will still produce a large part of the incremental GDP, but it's going to be much less. So commodities are going to be weaker. Never mind the short covering bounce in commodity markets. A whole part of the world which depends on commodities is going to have less purchasing power. So that way the fundamental terrain has definitely shifted. China is not as bad as the world made out to be. The world made it out to be like a 3%, a recession. The word recession was used for a country that's growing 6 to 7%. Maybe it's not 7, maybe it's 6.5. But words like these were clearly creating a scare. But the terrain has shifted. It is going to be slower than what the world was prepared for in the first half in terms of Chinese demand. And if China grows 0.5% less, the ripple effect, a multiplier effect, will be seen in a lot of commodity producing countries. So that is what the market has to take cognizance of, which is why you will come perhaps with what the technical analyst calls lower tops and lower bottoms. Now, whereas we bottomed at 7,996 in the previous downturn, now we bottom at 7,800. Same would be true of most of the global markets as well. So would be true of crude. If last time it bottomed out at perhaps 45 or 40, this time it went way below 40 in terms of bottoming out. And likewise, the top could also get lower. So that perhaps is a permanent change that we are seeing in the texture of the markets as well.
Indeed, Latha. As they say, if you could only, trade with the benefit of hindsight. Hindsight is 20/20. It's the foresight that's the problem, and that right now is not telling you anything about which way, the cookies will
So today you do expect that a sharp short covering rally?
I think that today is going to be a good day for the market for 2 or 3 reasons. One, because there are still some pending shorts in the system. Two, at lower levels, there is definite sign of bargain buying. 3, in terms of the retail mutual fund flows and DIF flows, we haven't seen stemming of that. And that really is the biggest support for this market right now, the way the domestic money is participating in this market, which actually is good news. If FIs are selling and DIs are buying, and if the market actually has made a durable bottom, that's good news. But my only worry is that, again, I could be wrong, looking at the screen, it's not telling me that, we've seen the worst at 7,800 and the market is ready to move on. That would be just way too poetic. Markets normally don't move like that. You normally have one more aftershock. And that is something that may come in the month of September or maybe in the month of October.
Yeah, now we should really get more global experts to find out if the less compelling reasons for a Fed hike statement which came from Bill Dudley day before yesterday will start eventually getting countered as you get GDP data and home sales data and durables data in the US, which is better and better. And 15 trading days from now to the FOMC is a lot of time and a lot of data. So, perhaps some hopes will open up for a Fed rate hike, or maybe you want to call it fears. Yes. So the next big trigger could come from the Fed itself and maybe not from China. We live in interesting times, but today is going to be a day when we are going to see a lot of green on the screen. In a bit, we will tell you which are the stocks where you can see those green shots. But for the moment, let's tell you what else we have lined up on the show for you this morning. Our market master for the day is Dipen Sheth, head of institutional research at HDFC Securities. Important because Dipen has always given us gems that you can pick up when the market is lower. And then, of course, global markets have rallied on the back of positive economic data from the United States. Bob Dahl, the chief equity strategist at Nuveen Asset Management, and George Marsical, the regional CIO of emerging markets at UBS, will join in to tell us how they will look at both developed market equities and emerging market equities. Lots of corporates will be joining us on the show today. KK Mohanty, the managing director of Gammon Infra, and Bharat Madan, the group financial controller of Escorts, will be joining us to discuss whether the Smart City program is going to mean a lot of orders. Of course, Gammon has other news coming its way. RC Venkatesh, the CEO of Dish TV, is also going to join in to talk about the company's business outlook for the rest of FY16. And Jay Shankar, the chief India economist at Religare Capital Markets, is joining in to track the macro picture as well, to give us a sense of whether we should expect a lot of egalitarian steps from the government ahead of the Bihar elections.
Indeed, that's something that the market will be watching out for. But the big cue for the market has been the US market over the last couple of days. Overnight, we saw a big rally of 2% with major indices out of the correction territory as a rebound in oil prices and more signs of strength in the domestic economy lifted sentiment. Here